Hey investors, I hope you're doing well. I've recently started buying stocks again. Even though the indices have been going up quite a bit this year, the recent pullback has made some stocks obtainable at a great price again. I'm primarily a fast-growing disruptive company investor since I like taking on more risk in my earlier years of investing and hope this can become more rewarding for me in the long term. But now I've started to add a more defensive side in my investments. Today I'll be sharing what stocks I've been purchasing and how much allocation I've put towards them. But before that, I'd love to know what stocks you are currently buying. Let me know in the comments. And by the way, I'll only be sharing some of my stock picks in this video, but if you want me to make an entire video regarding all of my investments, please be sure to let me know as well. Let's get into the video. The first stock that I've been buying recently is Evolution Gaming. Evolution Gaming is a Swedish company that provides live casino games with real dealers streamed online. Players can interact and play popular casino games like roulette, blackjack and poker in a more immersive and authentic setting compared to traditional online games. They also innovate by introducing new games and unique game variations, as well as incorporating interactive features to enhance player engagement. Overall, Evolution's services have contributed to the growth and popularity of live dealer casino games in the online gambling industry, and you will most likely see their games on almost every online casino that exists currently. Since Evolution is not directly dealing with the gamblers, means that they do not have to worry about authentication, fraud or the responsibilities for which lie with the operators themselves. This company is the pick and shovel approach to the online gambling industry that is projected to more than double in size over the upcoming 7 years. Evolution currently has an allocation of 4.9% in my portfolio, making it one of my smaller holdings, because I've only recently started buying. The company offers a starting yield of 2.1% and year to date the stock has been flat with an increase of only 0.02%. If we look at the price action over the long term, we can see that the stock has seen a massive gain of just over 600% in the past 5 years, which outperforms pretty much all of the major indices. The dividend growth rate has been crazy on this one. They currently offer you a starting yield of 2.1%, which is already solid, but on top of that, they have been increasing their dividends by an average of almost 86% in the past 5 years. Keep in mind though, that they currently have a payout ratio of just under 50%, which might mean that you won't see these crazy dividend hikes anymore. But since they are growing their bottom line revenue by so much, you can still expect some market-beating dividend increases. This because management is guiding towards a payout ratio of around 50% at all times, meaning that bottom line growth will increase their future dividend payments. And talking about growth, their revenue has increased from over $200 million in 2017 to just under $1.6 billion in 2022, meaning that they have a 40% revenue CAGR in the past 5 years. Looking at their bottom line, their net income has grown from $50 million to over $600 million in 2022, meaning that they have a 60% net income CAGR. As you may have noticed, they have significant profit margins on their revenue as well, it almost being 58%. For this growth, you are currently paying a forward PE ratio of under 19, which is, considering the growth, an incredible valuation. If we then look at the valuation side of things, we can see that out of our valuation models, we get an average price per share of over $170. We don't use a margin of safety in this valuation since all of our indicators that either increase or decrease the margin of safety have shown a deduction in the margin of safety, since the business is very, very healthy. This means that their fair value is the same as the average price per share out of our valuation models. And with the current price of just over $100, we get an incredible upside of almost 70%. The second company that I've been buying is Agree Realty, the first ever REIT that I've added to my portfolio. Agree Realty specializes in acquiring, developing and managing retail properties throughout the United States. The company focuses on providing high-quality retail spaces to a diverse range of tenants. Their portfolio includes properties in various retail categories, catering to the needs of both national and regional retailers. I've been adding quite a bit of Agree Realty in the past weeks, and it now makes up 5.5% of my portfolio. This is because just like the entire REIT sector, Agree has also seen poor price action this year, with the stock being down over 20% year to date. And over the long run, Agree has seen a price increase of just over 5%. It seems to be a recurring trend with REITs that they underperform the major indices, but keep in mind that we don't take dividends into account in this. And speaking of dividends, Agree offers a starting yield of over 5%. And similarly to companies like Realty Income and Stag Industrial for example, they pay monthly dividends. As for the growth rate, this is not looking too shabby either. The 5-year average growth rate in the dividends has been sitting at 6.8%, and since they started paying monthly dividends, they increase their dividends every 6 months now. Interest rates have been one of the major factors for the decline in share price for REITs. This is due to the fear of REITs, who are more debt heavy by nature, having to lock in their maturing debt at the current rates, making them way less profitable for shareholders. Agree Realty is one of the least affected REITs by this though, since they have no significant debt maturities until 2028. Agree also puts much pride into the fact that they have a high amount of investment grade tenants, and this is something not to sleep on. Their tenant portfolio consists of high quality companies like Lowe's, Walmart and Home Depot. And with such tenants, you can be assured that Agree will continue to receive rental income from these companies even during the toughest of times. Once again, we've performed a valuation for this company, and out of our valuation models, Agree got a fair value of $72.64. With Agree having some positive and some negative financial factors, we're left with a margin of safety of 15%. And applying this margin of safety, we get a fair value of $63.16, which is over 14% higher than the current price. And by the way, if you want to get access to this valuation model and all of the other models that we use in our videos, you can check in the description for our Patreon link where you can upgrade your investment journey. And the last company that I've been buying is ASML. ASML is a Dutch company that specializes in the design, manufacturing and supply of photolithography machines used in the semiconductor manufacturing process. ASML's technology plays a pivotal role in advancing semiconductor capabilities, allowing for creation of smaller, more powerful and energy-efficient electronic devices, with them having a monopoly on the most advanced photolithography machines available. Since I'm eager to get more exposure in my home country of the Netherlands, I've started to layer into this wonderful company. It currently makes up 2.8% of my portfolio, and I'm definitely looking to add more shares since the stock is down over 10% in the last month. ASML has seen a nice increase in its share price this year though, with the stock being up over 7% year to date. And the stock has been absolutely crushing it on the long term, with the stock being up over 200% in the past 5 years. The current yield of ASML is not incredibly high, sitting at just over 1%, which is fine for me since I don't mind a lower starting yield as long as the company is either growing their financial or growing their dividends. Talking about dividend growth, the rate that ASML has been growing their dividends at is very solid, with an average growth rate of just under 30% in the past 5 years. Keep in mind though that the dividend payments are done in euros and are converted to dollars if you hold them on their Nasdaq listing. This means their dividend payments will also be dependent on the current exchange rate of the euro against the dollar. And in addition to this, in the Netherlands, company pay an interim dividend and a closing dividend. And only since recently ASML has converted to paying dividends every quarter. This explains the 0 years of dividend growth. Their dividend safety is looking very nice, seeing as only 24% of their net income is used to cover their dividend payments, meaning that there is still more room for growth. And speaking about growth, ASML is a company known for its very consistent growth. All of their income metrics are way outperforming peers, with revenue growth being almost 35%, EBITDA growth sitting at just over 25%, and EBIT growth being just below 30%. But of course, for this growth you are also paying a higher price. With a PE ratio of around 30, ASML is quite a bit more expensive than its peers, but this does not mean it's overvalued. Once again, we have performed a valuation, and here we get an average price per share out of our valuation models of $668. Once again, we don't use a margin of safety since the financial factors of this company are rock solid. With the current price per share of $588, we get a nice upside of almost 18%, which sounds very attractive for a solid company like this. And that wraps it up for this video. I hope you enjoyed watching this recap of my stock purchases, and I'd love to hear what you think about these companies. Making these videos keeps me sharp in my investment decisions, and I'd love to make this a regular series on my channel. Thanks for watching, and I hope to see you on the next one.